Welcome to Talk Tickers.
Glad to be here today.
So on this deep dive, we are covering an interesting financial topic that honestly drives every single person listening to this absolutely crazy.
Yeah, even if you don't realize, it is actually a massive structural economic problem.
Right. I want you to think about the last time you tried to sign up for a new financial app. Or, just open a basic bank account online.
Or a crypto exchange.
Exactly. You find the app, you download it, you're excited to use it, and then you hit the wall.
The dreaded onboarding flow.
Right. It tells you to take a photo of your driver's license. Glare detected. Try again. Now take a selfie. Turn your head to the left. Blink twice.
Verification failed.
It is the spinning wheel of death.
It is basically the digital equivalent of waiting in line at the DMV. You are sitting on your couch and just yelling at your phone.
Yeah. And for us as users, it is just a nuisance, right? It is a bit of friction. But as an earnings call summarization platform, we are looking at the bottom line. What if I told you that little spinning wheel is actually a multi-hundred-million-dollar black hole in the global economy?
Which is why today we are looking at the invisible infrastructure of the digital economy. Identity.
But we aren't talking about passwords.
No.
And we aren't talking about those annoying two-factor codes sent to your SMS that never arrive on time.
No, today we are going much deeper. We are looking at a fundamental structural shift in how humans prove they exist to computers.
Because right now, the way we do it is bleeding corporate balance sheets dry.
Exactly. We are talking about the convergence of three technologies that I know sound like alphabet soup, but they represent one of the biggest asymmetric bets in the market right now. Decentralized identity, verifiable credentials, and zero knowledge proofs.
DDs, VCs, and ZKPs. It sounds highly technical, and I know some of you might be reaching for the skip button right now, but do not.
Yeah, don't do that.
Because this is not a tech story. This is a balance sheet story. This is a story about why financial institutions are bleeding money and how they are about to stop.
That is the real so what here. We are looking at a complete restructuring of cost centers in financial services.
Right.
Right now, major institutions, we are talking the big banks, the major brokerages, they are spending anywhere from $60 million to $500 million annually just on KYC and AML compliance.
Let's quickly define that for the uninitiated. KYC is know your customer.
Yep.
AML is anti-money laundering.
Correct. These are the regulations that say a bank absolutely must know who you are, and they have to know that you aren't a terrorist before they let you move a single dollar.
And complying with these rules is a massive drag on capital.
A huge drag.
So the thesis we are exploring in this deep dive is simple, but it is radical. We are moving from a model of federated identity,
Which is basically logging in with big tech.
And siloed identity, where every bank hoards its own data. We're moving from that to something called self-sovereign identity.
Self-sovereign identity. I know it sounds almost political, but in this context, it is purely economic.
How so?
It means shifting liability away from corporations and shifting friction away from users. It is a move from a model of trust me, where you just have to trust an institution's opaque reporting to verify me.
Verify me.
Yeah, which is based on mathematical certainty.
Okay, let's unpack this, because before we get to the solution, before we get to the sci-fi cryptographic stuff, we have to really understand how broken the current economics of identity actually are.
It is so broken.
We mentioned that $500 million number. Where does that money actually go? I mean, is it all software licenses?
See, that is the common misconception.
Yeah.
Investors look at earnings reports and they see compliance costs and they just assume it is IT spend.
Right, servers and cloud storage.
It is not. It is labor. It is human beings.
Wow.
When you look at the breakdown of these operational reports, the vast majority of that spend is on literal armies of compliance officers staring at PDFs and spreadsheets all day.
So it is manual detective work.
It is incredibly manual and is incredibly messy. Let's say you are a bank onboarding a corporate client. This is not just checking a simple box.
What do they have to do?
First, you have to verify the business entity itself. Is it real? Is it in good standing? Then you have to verify the UBOs.
The ultimate beneficial owners.
Exactly. Who actually owns the company? Is it a shell company owned by another shell company owned by a guy who happens to be on a sanctions list in a jurisdiction you have never even heard of?
And a human being has to physically trace that chain.
A human has to trace it. They have to document it. They have to sign off on it. And the stats here are just wild.
Lay them on me.
Onboarding a single corporate client can cost a financial institution between $1,500 and $3,500.
Wait, hold on. $3,500 just to say, yes, you can open an account?
Correct. That is literally just the cost of opening the door.
Yeah.
That is before they have made a single dime of revenue from that client.
So you start the relationship $3,000 in the hole. Well, that explains why fees are so high for small businesses. If a small business is only going to generate, say, $500 in fees a year, the bank literally cannot afford to take them as a customer.
It creates a completely perverse incentive structure. It effectively redlines small actors out of the formal economy because the cost of compliance far exceeds the potential revenue.
And even for retail customers, just regular people like you and me opening a checking account.
Right.
It costs anywhere from $13 to $130 just to verify us. When you multiply that by millions of customers, the cash burn rate is incredible.
And that is if they actually finish the process.
Right, the drop-offs.
We call these conversion killers. We talked about the spinning wheel of death earlier. The friction of uploading passports and utility bills causes what we call KYC fatigue.
I have definitely felt that.
We all have. Drop-off rates during onboarding can exceed 50%. In some high-friction sectors, it actually hits 70%.
Imagine a department store where 70% of the people who walk up to the front door just turn around and leave because the door handle is too heavy to pull.
That is the perfect analogy.
That is exactly what digital finance is doing right now.
You were just throwing away revenue at the very top of the funnel.
But the problem isn't just the cost and the friction, right? It is also the risk. We are dealing with what the source material calls centralized honeypots.
This is the security nightmare. Traditional identity systems store user data in massive central databases.
Right.
If you are a hacker, this is the absolute jackpot. You don't try to hack 1 million individual users. That is inefficient.
You hack the one database that holds 1 million records.
Exactly. We have seen this happen over and over with Equifax, with Target, with Marriott.
It creates a single massive point of failure and a high-value target. And for you as the user, this leads to the federation problem.
Yep, we all do it.
You see a new service, and instead of creating a brand new account, you just click log in with big tech giant. It is convenient.
I do it every day, honestly. I don't want to remember another password.
But it creates dependency. You are effectively renting your identity from a tech giant.
Right.
If that company decides you violated some opaque term of service and they lock your account, you lose access to Spotify, your Airbnb history, your New York Times subscription.
You have traded your sovereignty for convenience.
You are basically building your entire digital life on rented land.
Precisely. And they are tracking you across that land.
Yeah.
It creates a surveillance capability that is just baked into the basic architecture of the web.
There is one more aspect of the broken system we need to touch on before we get to the solutions, which is digital disenfranchisement.
This is a big one.
Approximately 850 million people globally cannot claim ownership of their identity.
That is a staggering number. Almost 1 billion people are completely locked out of the formal financial system.
Why?
Because they don't have the paper trail. They don't have the utility bill in their name or the formal government ID that centralized compliance teams rigidly require.
So they exist, but they are invisible to the economy.
Exactly. They can't bank, they can't borrow, and they cannot build wealth.
So just to recap the problem before we move on. The current system is expensive, costing billions in manual labor and dragging down earnings.
Yes.
It is high friction, causing 70% of customers to drop off. It is dangerous, creating massive honeypots for hackers. And it is exclusionary, locking out 1 billion people.
It is objectively, utterly broken. And that is why the shift to self-sovereign identity isn't just some nice idea or a privacy activist dream.
It is an economic necessity.
It is an economic necessity for these institutions to survive and maintain their margins.
Okay, so let's get into the solution. The architecture of trust. It starts with DIDs. Decentralized identifiers. I need you to explain this to me like I am 5. How is a DID different from, say, an email address?
Okay, think about an email address. Who actually owns it?
Well, if I have a Gmail address, Google owns it.
Right, and they can shut it down. If you have a phone number, the telco owns it. A DID is a new type of globally unique identifier that is generated and earned by the entity itself, whether that is a person or an organization.
So no one grants it to you. I don't go to a DID store and buy one.
No central authority grants it to you. And more importantly, no central authority can revoke it.
How does that work?
The mechanism is based entirely on cryptography. You generate a public key and a private key. The DID is essentially the public address stored on a distributed ledger or some decentralized network.
And the control lies in the private key.
Right. As long as you hold the private key, you control that identity. It is the absolute root of your digital existence that does not depend on any third party.
It is kind of like owning your own domain name system, but for your actual personhood.
Yep.
And you are the registrar.
That is a very fair analogy. But a DID on its own is really just a string of numbers. It is boring.
Right.
It doesn't tell me your name or your age or your credit score.
Which brings us to the second pillar of this architecture, verifiable credentials.
Or VCs. This is where the magic actually happens. Let's use the digital wallet analogy. In your physical pocket, right now you have a wallet. Open it up. What is in there?
Okay, let's see. Driver's license, credit card, a Costco card, maybe a gym membership I haven't used in 3 years.
Right. Now, did you print that driver's license yourself?
No, the DMV issued it.
Exactly. The DMV is the issuer.
Yeah.
You are the holder. And when you go to a bar and the bouncer checks it, the bouncer is the verifier.
That is the triangle of trust.
That is the triangle of trust.
Okay, so we have the issuer, the holder, and the verifier. How does that translate to the digital world?
Well, in the current federated model, like logging with Facebook, we actually skip the holder completely.
Explain that.
When you use Facebook to log into Spotify, Facebook is the issuer, and they talk directly to Spotify, the verifier. They say, yes, this is him. You aren't holding the credential. They're holding it for you.
And because they are talking directly, Facebook knows I am using Spotify. They see the transaction in real time.
Yeah, exactly. In the VC model, we completely break that link. The university issues your digital diploma. They cryptographically sign it using their DID.
Okay.
Then they hand it to you. You put it in your secure digital wallet on your phone.
So I have the actual file. It is on my device.
You have the file. Now, when you apply for a job, you present that file to the employer. The employer checks the cryptographic signature against the university's public DID on the blockchain.
So the math just proves that the university signed it and that I haven't tampered with it.
Right. If a single bit of that data is altered, the signature immediately breaks.
And does the university know I applied for that specific job?
No. The university is not in the room. They issue the credential and they walked away.
Wow.
The verification happens directly between you, the holder, and the employer, the verifier. This is the separation of powers. It completely prevents the issuer from tracking where the holder uses their credentials.
That is a massive, massive shift in privacy. But let's talk about the money again, because this is talk tickers. We talked about those high onboarding costs. How does this fix that specifically?
This leads us to the killer app of this whole space. Reusable KYC.
Reusable KYC.
This is the collect once, verify often concept.
Okay.
Imagine a user undergoes that really painful, expensive, deep KYC process with a major bank. They bring in the passport, the utility bills, the whole 9 yards. The bank spends the $100 to verify all of it.
So the bank has done all the heavy lifting.
Right. Now the bank issues a KYC verified credential to the user's wallet. Think of it as a golden ticket.
So now I have this digital token that definitively proves I have been vetted?
Correct. Now, a month later, when that user goes to a crypto exchange or a neobank, they don't upload the passport again. They don't take a selfie.
I just present that KYC verified credential.
Exactly. And the new institution just checks the cryptographic signature of the original bank. If they trust the bank, they trust the credential, boom, verified.
So we are moving from onboarding, taking days of manual human review, to literal seconds of cryptographic checks.
And the stats back this up beautifully. Reusable KYC can lead to 50% faster onboarding. We are seeing conversion rates jump by 30%.
Which makes sense, because if you don't have to get off the couch to go find your physical passport, you are just much more likely to actually finish the sign-up flow.
Exactly. We have seen some real-world examples of this in the source material. Mercurio is a great one.
Right, Mercurio.
They used reusable KYC to unify onboarding across something like 200 different companies, just unifying crypto as fiat ramps completely.
And Paydo is another one mentioned.
Paydo is fascinating. They increased approval rates by 10% and reduced fraud by 23%.
Wait, why does fraud go down? I would think making it easier might increase fraud.
Because you are removing the human element from the re-verification process.
Ah.
Humans make mistakes. We get tired. We misread a document. Math doesn't get tired. When you eliminate the manual recheck, you eliminate the human error.
That makes perfect sense. So that handles the identity part. I can prove who I am. But we still have a privacy issue here.
How so?
Well, even if I have a digital license, I might not want to show the bouncer my home address just to prove I am 21.
That is a crucial distinction. Identity is who you are. Privacy is what you reveal.
Right.
Which brings us to the third pillar, and frankly, the most mind-bending one. Zero knowledge proofs. or ZKPs.
I love ZKPs, but I struggle to explain them to people.
It is definitely not great party conversation, but the core proposition is actually simple. It is proving a statement is true without revealing the information used to prove it.
The classic analogy in the space is the Alibaba cave. Let's walk through that because I really think it helps visualize the magic happening here.
Okay, imagine a circular cave. It has one entrance, but it splits into two paths, path A and path B.
Got it.
They loop around and meet at the back of the cave, but at the back, there's a magic door blocking the way. The only way to open that door is if you know the secret password.
Okay, so I want to prove to you that I know the password, but I don't want to actually tell you what the password is.
Right, so I stand outside the cave entrance. You walk in and you choose a path, A or B. I cannot see which one you took.
Okay, I'm in the cave.
Once you are deep inside, I walk up to the entrance and I shout, "Come out, path A."
Well, if I am stuck on the path B side and I don't know the password, I can't get to path A. The door blocks me.
Exactly. But if you do know the password, you can open the door, walk through, and come out path A.
But if we just do this once, maybe I just got lucky and entered path A to begin with, that is a 50-50 chance.
Right, so we do it again.
And again.
We do it 20 times, come out path B, come out path A. If you successfully appear from the correct path every single time, I can be statistically certain, like 99.999% certain that you know the password.
And I never once shouted the password to you.
Exactly. Now that is the interactive version. You and I have to go back and forth shouting at a cave. But in modern blockchain systems, we use non-interactive ZKPs.
Like ZK snarks or ZK starks?
Yes. The math allows us to generate a single succinct proof packet. I can hand you this packet, and you can run a quick calculation that verifies I know the secret without me ever interacting with you directly again.
Okay, so that is the cave. Let's bring it back to the real world. Let's bring it to the bar. How does this apply to buying a beer?
This is what we call selective disclosure. Currently, when you hand over your physical driver's license to a bouncer, he sees everything.
Right, my name, my address, my exact date of birth, even my organ donor status.
He doesn't need to know where you live to know you are allowed to drink beer.
He just needs to know, is age greater than 21?
Exactly. With ZKPs, your digital wallet communicates with his scanner. The scanner essentially asks, is age greater than 21? Your wallet runs a proof against your verified credential and simply answers true.
So the bouncer just sees a green check mark.
A green check mark. He doesn't see your date of birth. He doesn't see your address.
And bringing this back to finance, this application is absolutely huge for high net worth individuals and institutional investors.
Oh, it is massive. Think about proving you are an accredited investor.
Right.
Right now, you have to send a brokerage statement showing you have $1 million in assets. You are literally showing a total stranger your entire financial position just to get access to a private deal.
With ZKPs, I can just prove assets greater than 1 million without revealing my total net worth or what specific positions I hold.
You prove you qualify without ever showing your hand.
This also leads to something called compliance by design, or programmable privacy. This feels like the ultimate bridge between the crypto anarchists and the traditional regulators.
It really is the only bridge that works. Because regulators want to stop bad guys. Privacy advocates want to protect good guys. ZKPs solve both simultaneously.
How?
You can embed regulatory rules directly into the ZK circuit. Take sanctions checks, for example.
Like OFAC lists.
Right. If I want to send you money, the network needs to know we aren't terrorists. A transaction can carry a ZK proof that mathematically attests neither the sender nor the receiver is on an OFAC list.
And the network verifies that statement is true.
But the public ledger does not reveal who the sender or receiver actually is.
So the compliance is verified, but the identity remains shielded.
Exactly. Or take AML thresholds. If I send $9,000, I can attach a proof that says amount is under the $10,000 reporting limit.
And if you send 11,000,
then I attach a proof that says the required AML reports have been successfully filed with the proper authority.
So the public sees the proof, but they don't see the actual amount transferred.
It maintains the absolute privacy of the transaction while cryptographically guaranteeing compliance. It converts compliance from a retroactive audit, let's check the paperwork 3 months later, to a proactive automated software function.
You literally cannot settle the transaction unless the compliance proof is valid.
Exactly. It fundamentally changes the operating margins for financial services.
That is a total game changer. So we have the identity layer with DIDs and VCs, and we have the privacy layer with ZKPs. Now let's really look at the strategic implications for finance. How does this change the game for market structure?
The first major implication has to be proof of reserves.
We absolutely have to talk about this, especially because of what happened in the last cycle. FTX, Celsius.
Right. The Trust Me model failed spectacularly. Customers deposit money into a black box exchange. The exchange says, don't worry, guys, we have your money.
But as we saw with Sam Bankman-Fried, they might be using that money to buy luxury condos in the Bahamas or trade incredibly risky derivatives.
And you don't know they're insolvent until the run on the bank starts.
And by then, it is way too late to get your money out.
The ZK solution changes this entirely to a Verify Me model. It uses two parts. First is proof of assets. This allows an exchange to prove they own certain on-chain funds without revealing the exact wallet addresses to the public.
So they aren't doxing their cold storage security to hackers.
Exactly. And the second part is proof of liabilities. This is the really clever part. It aggregates all user deposits into a Merkle tree.
Briefly explain a Merkle tree for the listeners so we are all on the same page.
Sure. Imagine a tree where every single leaf at the bottom is a specific user's account balance. You hash them, you turn them into cryptographic slings.
A hash is basically a one-way mathematical function, right? Like grinding meat.
Perfect analogy. You can't ungrind the hamburger to see the original cut of meat. So you hash the balances and combine them up the branches of the tree until you get a single root hash at the very top.
And that root hash represents the total liabilities of the exchange.
Yes. And as a user, you can check that your specific leaf year balance is accurately included in that overall tree.
So if everyone can verify their own balance is in the tree and the root hash matches the total, then we know the liabilities are mathematically accurate.
Exactly. Then you generate a solvency proof. You just prove mathematically that assets are greater than or equal to liabilities.
And this isn't some PDF audit report that gets released quarterly.
No, this is continuous mathematical solvency auditing. You could theoretically check it every 10 minutes.
That feels like it should just be the regulatory standard for any custodian of digital assets. If you cannot prove solvency mathematically, why should anyone trust you with their capital?
I think eventually the market and the regulators will demand exactly that. Don't tell me you are solvent, prove it.
Okay, let's pivot to institutional trading. Big institutions, we are talking Goldman, BlackRock, they want the settlement speed of public blockchains. They want the liquidity of Ethereum.
But they absolutely cannot expose their proprietary trading strategies or client data.
Right. If I'm a big desk and I am accumulating a massive position in, say, a tokenized version of Apple stock, I can't have the whole world seeing my trades in real time on a public block explorer.
They will front run you instantly. Transparency is a massive bug for them, not a feature.
So how do they actually use public chains then?
This is where shielded transactions come into play. Institutions can use what are called shielded pools. You deposit assets into a pool and you withdraw or transfer them using ZKPs. The ledger records that a valid transaction happened. The math perfectly balances. But it does not record the sender, the receiver, or the amount publicly.
But the regulators will hate that. I mean, it sounds exactly like a dark pool. It sounds like money laundering heaven.
That is the knee-jerk reaction for sure, but that is where view keys come in. And this is the critical innovation. In a ZK system, I can have a private key for actually spending the money, but I can also generate a completely separate view key.
A view key, what does that do?
It allows the holder to decrypt and view the entire transaction history, but it does not give them the power to spend the money. So the institution simply hands the view key over to their regulator or their auditor.
So the regulator can see absolutely everything.
Everything. Total granular transparency for the referee, but for the competitors, total opacity.
It is the holy grail. Regulatory compliance combined with compenditive secrecy.
Exactly.
Yeah.
It is the only thing that makes public blockchains actually safe for institutional capital.
And we cannot talk about this infrastructure without talking about scalability, ZK rollups. This is the real infrastructure play for investors looking at this space.
This is the execute once, verify everywhere principle. Right now, public blockchains like Ethereum are slow because every single node has to process every single transaction.
It is hugely redundant. It is like if every single employee at a bank had to personally sign every single check that came through the building.
That is exactly what it is like. With ZK rollups, we move all that heavy computational lifting off-chain. We bundle thousands of transactions or even complex risk models, and we process them on a high-performance off-chain server.
Okay.
Then we generate a tiny, succinct cryptographic proof that basically says, hey, we processed these 5,000 transactions according to the strict rules of the network, and here is the new final balance.
And the main blockchain just verifies that one tiny proof.
Yes. It verifies the proof in milliseconds. It allows us to get Visa-level throughput. We're talking thousands of transactions per second without sacrificing the underlying security of the main chain.
This is what makes decentralized finance actually usable for things like high-frequency trading.
Exactly. You cannot do HFT on Ethereum layer 1. The block time is 12 seconds. It is just way too slow. But with ZK rollups, you can execute off-chain at the speed of a centralized server and still settle on-chain.
It paves the highway for financial products that simply cannot exist today.
Without a doubt.
Okay, this all sounds utopian, right? Faster, cheaper, more private, more secure, infinitely scalable. But I have to be the skeptic here. What stops this from just happening tomorrow? What are the actual hurdles?
Well, there are three main hurdles we need to look at: regulatory friction, the bootstrap problem, and human factors.
Let's start with regulation. Specifically, the source material mentions the sunrise issue.
Right. This is a very messy geopolitical problem. The internet is inherently global. TCP/IP works the exact same way in London as it does in Lagos. But financial law is hyperlocal.
Right.
The FATF, the Financial Action Task Force, sets global standards. Things like the travel rule, which requires virtual asset service providers to share sender and receiver data.
But the FATF doesn't actually make laws. Countries make laws.
Correct. And the sun rises at different times in different jurisdictions. Switzerland might pass a law today requiring strict travel rule compliance.
Well, Panama might not pass it for 3 years.
Exactly. So you get massive friction. The Swiss bank is legally required to identify the counterparty. The Panamanian bank isn't set up to receive that data or provide it.
So the transaction just fails or gets flagged?
You get liquidity fragmentation, you end up with clean pools in regulated markets and gray pools elsewhere.
Can technology actually solve this diplomatic issue?
That is the hope. If we use DIDs and VCs, I can attach a verifiable credential to the transaction payload itself. I can cryptographically prove I am compliant without the counterparty needing to be fully integrated into my local banking system.
So the tech can outpace the diplomacy.
That is the goal.
Then there is the bootstrap problem.
It is the classic chicken and egg network effect problem. Issuers absolutely need verifiers to make the credentials useful in the real world.
And verifiers need issuers to make the system worth building in the first place.
Right. If I have a digital wallet full of verified credentials, but literally no bank accepts them, they're just useless digital toys.
And conversely, if a bank spends millions of dollars building a VC reader, but no customers actually have VCs, they just wasted their money.
We desperately need standards, like those being developed by the Decentralized Identity Foundation or the W3C. So a credential issued by Bank A seamlessly works at Bank B. Interoperability is non-negotiable for this to scale.
And finally, the human factors. This is honestly the one that scares me the most. Grandma losing her private keys.
Key management is terrifying for the average retail user. We are so used to the forgot password button.
You click a link, you get an email, you reset it. Easy.
But in self-sovereign identity, if you lose your private key,
you lose your identity.
You lose your identity. You lose your assets. There is no customer support number to call. There is no system admin who can just reset it for you.
That is a really hard sell for mass adoption. I mean, I don't trust myself with a private key, let alone my grandmother.
And that is exactly why we're seeing the rise of social recovery. This is a truly critical innovation in the space.
How does that work?
Instead of relying on a piece of paper hidden in a physical safe, you designate guardians.
Who are the guardians?
They can be trusted friends, family members, or even trusted institutions. Let's say you pick yours about your brother and your lawyer.
Okay.
If you lose your key, you reach out to them. If a majority of them, say 2 out of the 3, confirm to the smart contract that it is actually you, the contract allows you to generate a brand new key.
Oh, wow. So it bridges the gap between mathematically self-sovereign and practically human.
Exactly. It makes the system forgiving enough for real people to actually use it without living in constant fear. And ultimately, the user experience must be completely invisible.
Users shouldn't know they are generating a ZK proof.
Not at all. They should just see a verify button.
If I have to understand elliptic curve cryptography just to buy a cup of coffee, we have fundamentally failed.
100%. It has to be exactly like the internet today. You don't know how HTTP works under the hood, but you know how to browse the web.
So let's bring this all home to the investor context, because we are talk tickers. If you are managing a portfolio or just looking to position yourself for the next decade of digital finance, how do you actually play this?
First, you have to look at the portfolio implications. This is an infrastructure play. Do not look for the flashy consumer apps right now. Look for the shovels and pickaxes.
The proto layer.
Yes.
Yeah.
The companies building the core standards, the members of the W3C and DIF, the ZK rollups that are scaling the networks. These are the underlying rails that the future economy will run on.
And there's a massive efficiency alpha here.
Absolutely. This is a pure margin expansion story. Banks and fintechs that aggressively adopt reusable KYC will have structurally lower customer acquisition costs.
If I can onboard a customer for $5 while my competitor is spending $100 manual review, I have a massive structural competitive advantage.
And you will have significantly lower churn.
Why is churn lower?
We talked about passive compliance earlier. Imagine your passport expires. In the old world, the bank locks your account and demands an upload. You get angry, you leave.
In the new world,
your wallet simply notifies you to renew your credential with the government. You do it. The credential updates in your wallet automatically.
and the bank.
The bank just periodically checks the wallet, sees the new valid date, and never interrupts your service. You didn't even know a compliance check happened.
That is the dream. Passive, continuous, friction-free compliance. And from a macro view,
Data sovereignty. We are rapidly moving toward a world where holding user data is a massive liability, not an asset. It's toxic material.
because of the honeypot risk.
Exactly. Smart companies will use DIDs to verify data without ever storing it. This essentially solves for GDPR compliance and reduces cyber risk effectively to zero for that specific vector.
It is shifting the whole paradigm from who you know, which is federated trust, to what you hold, which is cryptographic keys.
It is the fundamental shift of our era.
All right, we have covered the broken economics, the architecture of trust, the privacy layer, the financial implications, and the hurdles. Now it is time for the outro. The one question.
The question every single investor needs to ask their portfolio companies, whether they are fintechs, banks, or crypto protocols, is this. Does your identity stack rely on federated trust or cryptographic verification?
And why does that ultimately matter to the bottom line?
Because federated trust guarantees constantly rising security costs, rising insurance premiums, and endless legal liability. Cryptographic verification converts compliance from a bloated operational expense into a highly efficient automated software function.
It is the difference between hiring an army of lawyers and running a single line of code.
Precisely.
That is the bottom line. Stop paying for trust, start verifying it. Wait, before we fully sign off, I want to circle back to one very specific thing you mentioned earlier, the honeypot risk.
All right.
We talked about hackers, but we really didn't talk about AI. I want to put a finer point on that for the risk managers listening.
You are right to bring that up. In the age of AI, the risk isn't just basic data theft anymore. It is synthetic identity fraud.
Deepfakes.
Exactly. If I hack a centralized database and I get your high-resolution passport, scan your voice print from a call center recording, and your transaction history, I can essentially become you.
You can become a highly convincing digital version of me.
I can generate a real-time video of you applying for a loan that completely fools a human underwriter. And I have the stolen documents to back it up.
Centralized databases are essentially just feeding the training data for AI-driven fraud.
It is terrifying. And that is exactly why Verify Me using ZKPs is so incredibly critical right now.
Yeah.
In a ZK world, I never give the central database my raw biometric data.
Right.
I just prove that my face matches the cryptographic hash on the blockchain. The database never actually sees the face. So if the database gets hacked, the hackers get nothing but mathematical proofs that are entirely useless to them.
So decentralization is actually the only real defense against AI threats.
It is the only viable defense. You cannot secure a central database against an AI that has infinite attempts and infinite patience. You simply have to remove the target data from the equation entirely.
That is an incredibly powerful place to leave it. The shift from trust me to verify me isn't just a tech upgrade. It is a complete rewrite of the social contract of the internet. And for you as an investor, it is a chance to get in on the ground floor of the new invisible infrastructure.
Couldn't say it better myself.
Thanks for listening to Talk Tickers. Keep asking the hard questions, and we will see you on the next deep dive.